When you make that monthly mortgage payment, do you ever really stop and think about where that money goes? I mean, you send it off to whatever company's name is on the statement. But here's a little secret. Chances are they don't actually own your loan. So who are they, and what are they doing with your cash? Well, it turns out there's this hidden multi-billion-dollar industry sitting right between you and the real owner of your loan. And today, we're going to pull back that curtain. First up, we're going to follow your money and see where it goes. Then we'll dive into what happens when those payments suddenly stop. We'll look at how two massive crises, the 2008 meltdown and the COVID-19 pandemic, pushed this entire system to the absolute brink. And finally, we'll get into the really big trade-off, protecting homeowners versus the actual cost of buying a home. All right, so let's start with the basics. We're following the money. The moment you click pay on that mortgage bill, you're kicking off this surprisingly complex chain of events, all managed by a key player you've probably never given a second thought to. And that key player is the mortgage servicer. The best way to think of them is like a financial traffic cop for your home loan. They don't own the loan itself. That belongs to someone else, the lien holder. Now, that could be the bank that gave you the loan in the first place, or it could be a group of investors who bought it. The servicer is just the middleman, the one hired to handle all the administrative nuts and bolts. So when you make that payment, it gets sliced and diced. It goes to the servicer, who immediately takes their small fee. We're talking a tiny fraction of a percent. Then they send the rest where it needs to go. The principal and interest zips over to the actual loan owner, your property tax money gets tucked away into an escrow account for the local government, and your insurance premium is sent off to your insurance company. It's a huge, crucial job that, when it works, is totally invisible. Now, that smooth process is great when everything is going according to plan, but the servicer's job gets way more complicated and a whole lot more important when a borrower runs into financial trouble and suddenly the payments stop coming. And this is where things get really, really critical. When a homeowner is facing a hardship, they aren't calling up some faceless Wall Street investor who owns their loan. Their one and only point of contact is the servicer. The servicer's job is to minimize the financial loss for the loan's owner, but that also means they have a whole toolbox of options to potentially help a borrower avoid the worst-case scenario. And that toolbox has a fancy name, loss mitigation, which basically just means trying to fix the problem. The options can range from something simple like a repayment plan to catch up, all the way to forbearance, where payments are just paused for a while. For more serious trouble, they might look at changing the loan itself, or if keeping the house just isn't an option, arranging a short sale. Foreclosure, well, that's always the absolute last resort. So you can see it really comes down to two very different roads with completely different destinations. A loan modification, that's a path toward recovery. The goal is to change the loan, maybe lower the interest rate or stretch out the payments so the borrower can afford it again and stay in their home. Foreclosure, on the other hand, is the end of the road. That's the legal process where the lender just takes back the property to sell it and try to get their money back. This entire system was put through the ultimate stress test on a massive, nationwide scale back during the 2008 financial crisis. It wasn't just a banking crisis. It was an unprecedented mortgage servicing crisis that showed just how fragile the whole setup really was. As home prices cratered and unemployment skyrocketed, millions of people fell behind on their mortgages. The servicing industry was just completely buried. They weren't built for that kind of volume. We saw lost paperwork, wrongful foreclosures. It was chaos. And that chaos led directly to Congress passing the Dodd-Frank Act. That act created a new agency, the Consumer Financial Protection Bureau, or CFPB, and basically told them, go write a new rulebook for these guys. And in 2014, those new rules finally went into effect. Okay, so a crisis forces a change. But what did that change actually look like on the ground for regular homeowners? Well, the whole point of these new rules was to make sure the disaster of 2008 could never happen again. For the very first time, these rules created a national floor, a basic set of protections for everybody. Servicers suddenly had clear deadlines. They had to try to actually talk to a borrower by day 36 of a missed payment. They had to give you a reason in writing if they denied you help. And, maybe the biggest deal of all, they were flat out banned from starting a foreclosure until a loan was at least 120 days delinquent. This created what you might call a 4-month runway to give homeowners a real shot at working things out. Just as the industry got used to the new rules, a totally different kind of crisis smacked into it. The COVID-19 pandemic wasn't about home values crashing. It was about the economy suddenly shutting down, which created this massive cash flow problem, what we call a liquidity squeeze for servicers. Just imagine if your paycheck suddenly stopped, but all your bills were still due on the first of the month. Now multiply that pressure by millions. And this one number pretty much says it all, 360. In response to the pandemic, Congress passed the CARES Act. It said that if you had a federally backed loan, you could request up to 360 days, a full year, of forbearance. No questions asked other than saying you had a COVID-related hardship. It was a critical lifeline for millions of families. But here's the catch. That lifeline for borrowers put a massive strain on the servicers. See, borrowers could pause their payments, but servicers were still on the hook. They were legally required to keep sending principal and interest payments to the investors who owned the loans. So you had millions of payments suddenly stopping on the inside, while the outside had to keep flowing just like normal. It was an unbelievable financial pressure cooker. And that brings us to the final and maybe the most important piece of this whole puzzle. Both of these crises, 2008 and COVID, they shine a huge spotlight on this central tension in the industry, the unavoidable tug-of-war between protection and cost. It's like a balancing act. On one side, you have the goal of making the system safer and more stable. You create rules that slow down foreclosures, that demand better communication, that force servicers to keep more cash on hand. All of that is great for protecting homeowners and the economy. But, and this is a big but, every single one of those rules makes it more expensive to be a servicer. And those costs, they don't just vanish. They can get passed right on to all of us in the form of higher mortgage rates or fees. So the crucial point, the real takeaway here is this. There's no such thing as a free lunch. Every step we take to make the mortgage system safer, whether it's for the family in the house or for the financial system as a whole, comes with a price tag. And that price is that it can make getting a mortgage and buying a home more expensive for everyone. Which leaves us with this fundamental, tricky policy question. How do we build a system that protects the homeowners who are in trouble today without making it so expensive that we price out the homeowners of tomorrow? Finding that perfect balance is one of the biggest challenges we face in housing today.